All right, I'm Michael Hartzman. Today is Tuesday, December 5th, 2023, and I'm on as always with my partner Dominick Tavella. Good evening, Dom. How are you?
Good evening, Mike. Doing well. Happy to be here with you again.
Happy we're together on a somewhat chilly night on Long Island, but I know you're down in Florida, so hopefully you have a little better weather than I do.
Not chilly for Florida standards, but not New York. So grateful to be here, but back in your neck of the woods real soon.
I understand that. And you know what? If it's chilly weather, there's always hope for a nice little Santa Claus rally. And we've been talking about the last couple of weeks, Dom, and it appears we're smack dab in the middle of a nice little year-end rally right now.
Uh, Wishful thinking and on both our parts, and it looks like it's coming to fruition. All of it due, Mike, with where interest rates have gone, having peaked out, a 10-year Treasury peaking out at about 5%. As of this morning, under 4.2.
Yeah, like
Really,
4.12, closer to 4.1.
with really dramatic decline in interest rates, and that's done wonders for the markets in general, and specifically the sectors of the markets that, for the most part, hadn't done well all year, have had a really good rebound. So hopefully the trend continues, but very dramatic decline in interest rates.
Let's stay on that topic for a minute. We can't really underestimate how dramatic a drop that was in about 2 or 3 weeks. So why don't you try to explain, why that happened and what the implication of that drop is?
Well, I'll give it my best shot, Mike, but I'm going to look for a big assist on your part. So interest rates had risen pretty dramatically, especially when we look at August, September, October, and all of it having to do with where the markets thought inflation was going, i.e., not declining anywhere near as fast as they had hoped, and the kind of action the Federal Reserve was going to have to take, increasing interest rates to decline, make inflation decline. So the markets were anticipating what the Federal Reserve was going to do, and two pauses in a row on the Fed's part, and interest rate inflation declining, interest rates following suit. And the market's now going from, hey, the Fed's going to raise interest rates, to the possibility, at least, that in the short run, maybe over the next couple of months, the Fed might actually decrease interest rates. And so that has put a real pressure, downward pressure on the interest rate markets. The kind of interest rate decline that, Mike, you and I haven't seen, they tell us, since the early 80s. I don't remember it. Do you, Mike?
Wow.
That kind of just incredibly dramatic decrease in interest rates. And we'll see what the Fed decides to do this month. But that's had lower interest rate environment is good for the economy, good for economic growth, and stocks have reacted accordingly.
I do think stock market, bond market, everything moves faster today. The amount of information available to people, their ability to react quickly. We used to talk about, when we first started our podcast, that volatility is here to stay in the stock market. Dom, I think volatility is here to stay in the fixed income market as well.
Hey, Mike, I bring it up, and I do think some of our clients, sometimes when I'm going through this, they think a little screw loose material, because you talk about a Bitcoin or an aggressive tech stock going up 10-15% or down 10-15%. We wouldn't even blink, right, Mike? You expect that kind of volatility. But a 20-year Treasury or a 10-year Treasury, the price of that bond going up or down 10-15% in a 30-day window, it's almost unheard of. I mean, again, to us that manage money, it's shocking that we could see interest rates and the prices of bonds go up and down that dramatically.
Look, it would be unheard of if it moved 10% in a year, let alone 30 days.
And we did see that kind of dramatic move in the bond market last year. That was a year we brought up many times where stocks didn't work, bonds didn't work. But we didn't expect it this year. But not only didn't we expect it this year, we didn't expect it in basically a 30-day period, 45-day period.
Right. So the fact that yields are coming down, interest rates are anticipated to come down. The after effect of that is the cost of doing business gets less expensive, which should improve earnings. Yes, the economy is clearly slowing down as well, as evidence of that. But all these things are kind of falling into place that investors and markets would begin to believe, Dom, that the Fed's work is basically done or almost done.
Yeah, and we don't usually do this. One of our favorites, a gentleman named Phil Orlando. I'm going to butcher it, aren't I? Phil Orlando from Federated. We're both big fans of him. He wrote a great article over the weekend. "Stick a Fork in It" is the title of the article, and it implies strongly that the Fed is done. The Fed is done raising interest rates. It more likely than not will be in pause mode as we see inflation, hopefully, but continue to go lower, and possibly, and that seems to be the rumor mill in the markets, we could even see the Fed starting to cut interest rates maybe as early as next March. So I think we're both on the same page on that commentary, Mike. I think the Fed is done raising interest rates.
I think they are. I think they are too. And we were with a very, very large financial institution about a month ago. They told us the same thing. But I will tell you, the market creating an expectation that the Feds are going to start lowering interest rates in March does make me a little nervous. I personally believe that's an unrealistic expectation unless the economy completely falls off a cliff between now and then.
Oh, and Mike, I'd like to emphasize, I think you're spot on that point. Look, the markets drove interest rates unreasonably high, i.e. the 10-year got to a 5% yield, anticipating what the Fed might do, anticipating where inflation might be. I think, in total agreement with you, Mike, that the markets are pushing interest rates unreasonably low, thinking that the Fed is going to be cutting interest rates by next March. Now, that may happen, but it's this pendulum that gets way too giddy on the upside, way too miserable on the downside. And the truth always somewhere in between. Unfortunately, I do think the market's gotten a little bit ahead of itself. I do agree with you on that, Mike.
Yeah, look, Dom, if you just simply look at the history of interest rate movements, they go up, they level off, they come down, right? Or they go down, they level off, and then, they always level off for a period of time. That's the only way the Fed measures whether they accomplish their goal. And just like the stock and bond market, which has a very short attention span, a lot of volatility, why can't we just be in a wait and see mode for 6 months? And then we could discuss what the Fed has to do next.
And Mike, you would argue that thought is reasonable, right? We don't have inflation yet at 2%, the target that the Fed wants. It's in that 3 to 4% range. And again, we're grateful, but it has slowed down. Inflation has started to roll over and come down, but it's still increasing, right? It's just not increasing at the same pace that it was a year ago. So we do need a little patience here. I do think the markets have gotten a little bit ahead of themselves. And to your point, volatility, right? That means that these up and down roller coasters will continue, in my opinion, for the foreseeable future.
Yeah, absolutely. Like foreseeable future, like the rest of our lives in this business.
I don't know too many years where we could have basically fallen asleep in January and woke up in December and it was all good. Not too many of those years, but our job is to manage the risk through that volatility. And sometimes we look really smart and sometimes not so smart. But the volatility, I do think, is here to stay, at least for the foreseeable future.
And speaking of smart, and again, I can't speak for you, but I always like to get guests on our show, which I believe is smarter than me, at least.
And I would agree, me as well. So
there you go. So tonight's guest is Sean McLeod. I think he fits the bill. He's a chartered financial advisor. He's a portfolio analyst, actually senior analyst, and a great friend of ours, Dana Investments in Wisconsin. They co-manage a lot of money for us. Sean's an integral part of what Dana does every day. We're going to talk a little bit about, dividends tonight, large cap, small cap, value. We're going to try to be all over the place, but I'm really looking forward to, maybe his comments on what we just discussed and where his firm sees, these things going into 2024. Hopefully he brought his crystal ball.
Looking
So
forward to it.
we will be right back with Sean McLeod after a quick break. All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Sean McLeod, chartered financial analyst, portfolio manager, and senior analyst at Dana Investments. Good evening, Sean. How are you?
I'm great. How are you guys doing?
We're doing well,
Doing
thank
great.
you.
Welcome aboard, Sean.
Thanks.
So, Sean, I know you were listening in on Dom and I's conversation in the beginning of the show. And what's your opinion, or what's Dana's official opinion on, what we just discussed, interest rates, and is the Fed done? Are they not done? The market reaction. Where do you guys chime in on all of that?
Well, we've been pleasantly surprised at the strength of the U.S. economy and corporate earnings. The soft landing scenario, in our view, seems increasingly likely. And I think, as you guys stated, was one of the reasons that the stock market was so strong last month. We are seeing, disinflationary pressures. That just means that inflation is falling, not negative, but inflation is falling. So that's a positive. The economy is slowing from sort of an unsustainable 5% print last quarter, but we think economic growth is going to stay positive. When you look at sort of the recent data, there's still 1.4 jobs for everybody that's looking, so that's pretty healthy, down from 2, but that's probably good for, inflationary pressures in the wage market. ISM above 50, signaling expansion. Consumers still have really good balance sheets. Their stocks prices are up, their home values are up. Most consumers, have fixed rate mortgages, and so they're not necessarily being squeezed by interest rates. And then if you look at the really most recent data like Black Friday shopping and Cyber Monday and stuff like that, those numbers look pretty good. And so we feel relatively good about the economy. And in terms of the stock market, the market's trading at 19 times 24 numbers, which isn't cheap necessarily, but it's not overly expensive. And if rates do begin to fall, like the bond market's telling us they will, I mean, if you look at the bond market, it's implying a bunch of rate cuts next year. If that happens, then the stock market is relatively cheap. And I would also add that if you look at the S&P 500 cap weighted, which is what we typically look at, it's trading at 19 times. But if you look at the S&P 500 equal weighted, which is every stock the same weight, the market is trading at 15 times. So what that implies or tells you is that the average stock is trading at 15 times earnings. And at 15 times earnings, we think sort of the average stock is pretty cheap. And so we're finding lots of opportunities in that environment.
Sean, you brought up a lot of issues there, so I'm going to just try to dissect a little bit of it. But we've been focusing all year on the equal weighted S&P, and obviously has not performed as well as the market weighted S&P. And yet we look at that equal weighted. In fact, we look at the dividend higher quality stocks, and they're trading at an unbelievable discount to where the market weighted S&P is. And yet they haven't performed well so far this year. It looks like they're starting to turn around. But what's your opinion on high quality dividend paying stocks?
We think now is a pretty good time to be buying into that sector. As you said, those stocks have really underperformed, and they've underperformed for a while. And I would say value stocks in general, which most dividend paying stocks are, they're much cheaper than they are on average. I mean, they should be cheaper than growth stocks because they don't obviously grow as much, but that discount is much bigger than average. And so we think there's going to be a valuation tailwind going forward as they close some of that multiple gap. And so we think now is a pretty good time to probably swap out of growthier stuff into a little bit more value-based opportunities, and dividend would certainly be one of those. The market has been dominated by, the Magnificent Seven or whatever you want to call Those stocks have done great this year, and everything else has been left behind. And so we think that gives you a little bit of an opportunity to look outside of that Magnificent Seven.
As Sean, as it relates to dividends, if I heard what you said about a soft landing, but if the economy slows down, we start worry about earnings. Does this become really a stock picker's market, as looking for those dividend payers, which are going to be, I think they're called even dividend aristocrats, where they're going to continue to pay their dividend or increase their dividend? Do you worry that if we do get a slowing economy, that some of these dividend payers are either going to have to eliminate or cut their dividend?
I would say the dividends in our portfolio, we feel very confident about. We don't think any of them are anywhere near having to cut their dividends. In general, that may be the case. Those stocks are not in our portfolio. But I would say, anytime the economy is weaker than you think, there's more stress in the system than people think. And so, some of those stocks that have highly levered balance sheets that also have high dividend yields will probably have to cut their yield, but we don't really own any of those companies. So we feel pretty good.
And Sean, on that point, what would you say? I know there's some really high dividend paying stocks, but those worry me sometimes because I don't know if they're sustainable. But what would you think is a good quality dividend return? And what would you say is the average in your portfolio?
Well, so our dividend yield is somewhere in the 2.5% to 3% range. Typically, if you segment the market by dividend yield, and the top tier, the highest paying dividends, those stocks I would say usually are value traps. They're over levered. They don't have any place to put their money. They have a high yield, and the businesses are generally in decline. And the reason they have high dividends typically is because the stocks are already gone down a lot, and they've gone down a lot because the fundamentals aren't very good, right? And so I think on average you want to avoid that top tier of dividend yielders because there's probably a signal underneath that the business underlying that will eventually have to pay for the dividend is in decline, and so we tend not to buy many of those stocks. Well, I think you're on mute.
Sorry about that. Sean, I know dividends is also the assumption that they're value stocks, but that doesn't necessarily have to be the case either, right? I mean, a good growthy company, every now and again, you can find a healthy dividend there as well, correct?
Right. I mean, if you think, like a Microsoft has a dividend, Visa, MasterCard, so not everything has to have, not everything's going to be a value stock. But there are also, a lot of great dividend payers out there. And I guess we look at value, I guess, a little bit different than say the Russell index guys. We tend not to look at price to book. We think price to book is a little bit antiquated. It's not as relevant as it was, say, 30 or 50 years ago. Our preferred measure is actually a normalized free cash flow number. And that simply means we normalize it for, say, the economic environment. So if we're at a peak or a trough, we normalize it. But we also normalize it for investment spend, because right now there's a lot of companies that their long-term investments are fully expensed as opposed to capitalized. And I'll just give you an example. Like, we own Meta in the dividend portfolio. Meta is spending $20 billion a year on the metaverse. At any point, if they wanted to, they could take that spending to zero. And the EBITDA would go up by 20 billion. So from 50 billion to 70 billion. So 40% of their EBITDA is being, expensed, and it could be capitalized. And so when you look at Meta as an example, Meta's trading at 16 times EBITDA, like 18 or 19 times earnings. But if you X out what they're spending on the metaverse, all of a sudden it's trading at 10 times EBITDA. And we would say, Meta would be an example of a value stock. Now, we own it, they don't pay a dividend, but their free cash flow return to shareholders through buybacks and dividends, if you look at sort of shareholder yield, it's about 5%. And so they're returning 5% of their cash flow to shareholders. They're just choosing to do it via a buyback instead of a dividend. And so if you look at our dividend portfolio, we manage the dividend at the portfolio level, not at the individual stock level. And so while 90% of the stocks in there have a decent dividend, a few don't, but they're all returning significant cash to shareholders. And the other example would be, Google, which has basically, they're buying back 4% of their stock a year. Meta's buying back 5%. And so we sort of include that in the shareholder yield and think, it's an alternative to a dividend that still benefits the shareholder.
So I'm a little bit surprised, but hopefully our listeners and viewers are as well. You think about dividend payers as utility stocks, or maybe some energy stocks, or some real estate stocks. You just mentioned Microsoft and Google and Meta. So you can get some of these growthier stocks in a good quality dividend portfolio and maybe get the best of both worlds.
Right. Now, just to be clear, we don't own Microsoft right now, but theoretically we could. But we own Meta and Google, right? But I would say the difference with our dividend portfolio and most other dividend portfolios is we look at the business first and the dividend second, right? And so we are not going to buy something just because it has a high dividend. We think that leads to disaster, right? And so you mentioned utilities. Utilities is a great example. And so utilities are looked at as bond proxies, right? Even though they're stocks, when interest rates go down, utilities go up. And when interest rates go up, utilities go down. It's just the way it is. And so when interest rates were at zero, basically a couple of years ago, utilities used to trade at like 15 times earnings. They went to 20, 25, 30 times earnings. We own 0 utilities in a dividend portfolio. Well, that's crazy, right? It's a dividend portfolio. Well, we didn't buy them because they're trading at what we thought were obscene levels, 25, 30 times earnings. We're not spending 30 times earnings for a utility, regardless of the dividend yield, right? And so we're looking for quality businesses at reasonable valuations. Utilities, even though they should be technically like in a dividend portfolio, we didn't own any. We haven't owned any for 2 years. And this year, as an example, utilities have had their worst year in, I think, 40 years, right? And so we avoided that whole sector because we care about the business and the valuation first and the dividend second.
So since you brought up some of the underperforming sectors, real estate's also had its struggles, Sean. And, most people buy a REIT or real estate investments, I think specifically for the dividend. So what is Dana's opinion on the real estate sector as interest rates are starting to fall a little bit?
Well, I mean, REITs are also looked at as bond proxies. REITs also tend to have significant debt loads. And so the fear is that, over time, their debt reprices higher and the spread that they make gets compressed, right? So our biggest REIT is actually gaming and leisure properties. It's basically a REIT that it's a triple net lease REIT, and they own casinos, regional casinos. This is a great business because if you think about the hierarchy of needs, it's food, drink, shelter, and gambling, right? People are going to gamble no matter what. And if you look at COVID, after the casinos were opened, after a few weeks, they were still full. And so like GLPI, they didn't lose a single dollar of revenue through COVID. Their competitor, which is Vici, they didn't lose a single dollar of revenue during COVID. They are 100% leased all the time, right? And so we think a name like that is going to do well regardless of the economic environment. They've proven themselves, and like GLPI has lower leverage than the average REIT. And so you don't have to worry about like office where you have, maybe some structural issues. Are people going to go into the office again? Regional casinos are like a gold mine, and people are going to gamble. And so that's a name that we own in the REIT space that we really like.
I did not anticipate that would be your answer. So that was really fascinating. Listen, we have a little less than a minute before the break, so let's take a break now, and then we can come back and have more time to go into some other sectors that you like and other areas besides dividend payers.
Okay, sounds good.
So we'll be right back right after this quick break. All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Sean McLeod, Chartered Financial Advisor, Portfolio Manager, and Senior Analyst at Dana Investments. Sean, just to stay on the REIT theme for a second, I completely agree with everything you said about gambling and casinos, that they're a gold mine. Another area which I really feel, because of the changing demographics, seems it would be a pretty safe bet is healthcare, whether it's hospitals or assisted living or nursing homes. Do you guys have an opinion on the healthcare sector, particularly real estate?
We don't own any healthcare REITs right now. So I don't really have an opinion on those. We do own some other healthcare names. We own Bristol Myers, Merck, as an example, in Medtronic. I would say, among those, I think Bristol Myers is universally hated right now. The stock has gone down every day forever, it seems like. And the stock is now trading at 6.5 times earnings. And we think that is just too compelling a story to not own at these levels. And so Bristol Myers is a name in healthcare that we've been buying recently in the Dividend product and in some other of our products as well.
So just to stay on that theme, and I know Dom wants to ask you about another sector. Do you guys have an opinion? And if again you don't, we didn't talk about this before the show, so if you don't have an opinion, that's fine. But where do you guys stand, if anywhere, on some of these obesity stocks and some of these obesity drugs that have really been the story of 2023?
Well, so not in the Dividend portfolio, but in some of our other portfolios, we do own Eli Lilly.
Mm-hmm.
But we are a big believer in these drugs. And so when we've done our work, so we think that the obesity market in the US by 2030 could be $100 billion in value. And that's above sort of expectations for what's in the models. So even though the stocks have done, and Novo Nordisk is the other player there. So even though the stocks have done well, we own Lilly. We also own Novo Nordisk in our foreign portfolio. We still think there's upside there. Conversely, even at $100 billion valuation or $100 billion in revenue, that's not a large percentage of the population in the U.S. taking the drugs. And so as a result, you've also had like the rest of medical devices do very poorly because people are worried that if you solve the obesity epidemic, you're going to need less hips and knee replacements. You're going to need less sleep apnea machines. You're going to need less of all those things that obesity is a primary cause of. And a lot of those sectors have done very poorly. We also think that that's probably an overreaction because even at $100 billion in revenue, it's only a few percentage of the U.S. population that's on those drugs. And so it's probably not enough to change the overall dynamics of the healthcare industry. But so we're sort of, a little bit contrarian there. We like those stocks because we think they're down too much. And we like Eli Lilly because we don't think the estimates are high enough yet. So
I think as long as seniors continue to play pickleball who haven't moved in 25 years, we're going to need hips and knees. And I think those companies will be fine, Sean.
Yep, we agree.
So just changing the subject matter a little bit, you mentioned value trap, and we all have a cell phone plan. We all subscribe to at least one of the two majors in the country, and these companies pay outrageously high dividends, but the stock price hasn't done really all that well, and frankly, for a really long time. So talk to us about value traps and the business model and maybe some things that should just be avoided.
Right. So the competitive environment in the cell business has not been good. And the real issue is that T-Mobile has been taking share and will continue to take share. And so basically, you have Verizon, who historically have had the best network and premium pricing. Then you sort of had AT&T in the middle. And then at the very bottom, sort of the dregs was Sprint and T-Mobile. Right. And so they were the value choice. Sprint, T-Mobile merged. They actually now have the best 5G network of anybody. They're far ahead of AT&T and Verizon. And so now what you're left with is that combination. They're taking share because they have lower prices and better service. And so you have Verizon that's stuck at too high a price point because they are no longer the premium network. AT&T stuck in the middle, and T-Mobile continues to take share. And so that's why those stocks have been so terrible for so long, is that they are positioned poorly and they will remain so. The other thing is that when you look at, say, an AT&T, for example, 30% of their revenue comes from declining businesses. That being direct TV, which eventually is going probably to zero, and landlines, right? And so 30% of their business is in decline. Verizon is not as bad, but maybe 15% of their business is in decline, right? And that's landlines. The other sort of wild card, which, I mean, I probably shouldn't even bring it up, is that they have a lot of stuff that's lined with lead. And so that is a potential liability down the road. I put a low probability on, but that's another risk factor that you have to be worried about. And so these businesses have seen sort of, no growth, declining core profitability for a long time. And we don't really think that's going to change much. T-Mobile will continue to grow faster than those guys. And now you have the cable guys that are introducing wireless plans, right? And so that's just more competition. And so we don't really see the environment getting better. And so we have avoided those names because we just don't think the businesses are in a good position to grow. The whole industry structure is not that great.
Switching gears again, and I appreciate you allowing us to be all over the place. This is what Dom and I normally do. The auto sector. If you have an opinion there, it appears that there's been a backlash in the last 6 months or so as it relates to electric vehicles. They were the next big thing 2, 3, 4, 5 years ago. Gas cars were going to be a thing of the past by 2040. And now, as I said, that seems to have cooled a little bit. Where does Dana fall, if anywhere, as it relates to the auto industry generally and EVs in particular? So
we do not own Tesla, GM, or Ford, basically the big three OEMs. And so we believe that the EV industry will continue to grow. It's just that expectations got way ahead of themselves, right? And so if you go back, at the Ford Analyst Day earlier in the year, they projected, and I forget, like a couple million vehicles that they were going to be able to produce. GM did the same. The problem is that their price points are too high, right? And there's not enough charging network. And so they had sort of unrealistic expectations. Everybody sort of got jazzed up about EVs, and the numbers were just too high. That doesn't mean they're still not growing. I think EV sales in the US are up 40% this year, or 50%. So it's still a very high growth market, especially relative to autos, which typically doesn't see much growth at all. And so we would say that GM and Ford are at a big competitive disadvantage to Tesla. Tesla's advantages, they have better battery technology. They have the ability to update their vehicles over the air. GM and Ford really can't do that. Tesla is vertically integrated. All their systems talk to each other. Ford and GM have outsourced everything. They've sort of lost their expertise. They don't have any software expertise to be able to have all these systems talk to each other. And then Tesla has lower costs, better battery technology, and they've done a lot of innovation. So, for example, they have a gigacast product, right? So the front end of the car is like one part instead of 130 individual parts, like in a Ford or a GM product that all have to be welded together or riveted together, right? And so Tesla has done a lot to lower costs. They continue to lower costs. And I just don't think that GM and Ford have the ability to catch up to Tesla. And so with that said, why do we own Tesla? Well, we have owned it before. We just think at the current, and I forget where the price is, $250. I'm not even sure where it is right now. We just think it's a little bit too expensive. And so we believe sort of in the long-term view of Tesla, but we are sort of negative on the short-term view. And the reason is that the Model Y and the Model 3 have gotten Tesla where they are today. They basically, this year, they'll produce 1.8 million of those units. Right now, we're sort of in a lull right now. The Cybertruck's coming out next, but it's not going to be high volume. They just can't produce as many. So the next sort of catalyst is going to be sort of the next generation car, which has a $20,000 cost of goods sold, selling for $25,000, right? That's the next big catalyst. That's probably not going to happen until 2025, 2026. I don't know when exactly it's going to ship. So we're sort of in this period right now where Tesla's growth is going to slow dramatically before the new vehicle takes off several years from now. And so we're sort of in this in-between phase where I'm not sure where the right price is. We're kind of a long ways away from the next catalyst. And so that's sort of the issue with Tesla. And then the other thing is that the elasticity of demand is probably a little worse than Tesla anticipated. So, I mean, they wanted a lower price and they expected, you lower price by 10%, it's going to increase volume by 20%, right? That elasticity is a little worse than they thought. I would say in part because of Musk's antics, all the things he's saying, he's turning some of his customers off. But then, people are still have range anxiety and everything else. And so it's going to take a little while to get over that hump as well. But I think long term, we like the Tesla story. It's just a matter of picking the right valuation.
And there's also this narrative, Sean, to certain, media sector, that EV cars are just for woke liberals. And as you said, it's on those charging stations. So there's also a bit of a backlash in general against, electric vehicles versus gas vehicles. And again, I don't think that's a long-term problem, but it does seem to be weighing on the sector in the short run, in my opinion.
Yeah, no, I agree. So I think what can change that is when the price of EVs is cheaper than the price of a gasoline engine, right? And so their next generation vehicle supposedly is going to cost $25,000, right? That is a compelling price point. And if they qualify for the Inflation Reduction Act credit, that's going to be $7,500 off at the point of purchase. So theoretically in 2026 or 2025, you'll be able to buy a Tesla model, we'll call it Model 2, for under $20,000. And I think that will be a catalyst to get people more interested in EVs. Because if you can actually save money and you don't have to pay for gas, you can charge it at home. There are a lot of conveniences. Now, of course, if I'm driving to Florida from Wisconsin, it's not so great because I got to stop a few times for a half hour. But for most people, if you can buy a car that's cheaper, you can charge it at home, never have to go to a gas station, that would be compelling. And I will say, like, the performance of these cars is pretty amazing too, right? And so, the Model X with 7 people on board off the line is almost as fast as a Ferrari, right? So that's like a family sedan or family SUV, which is the pickup of a sports car. And so that's kind of compelling too for some people.
So Sean, I just can't help take the opportunity to take the opposite on this trade. And that means energy companies have not done well this year. And yet they are producing more than they ever have and pay pretty good dividends and seem to run pretty strong balance sheet. So what's up with the energy trade, at least so far this year?
Well, I think it's basically because oil prices have been lower than people thought, right? And so, especially if you go back, even like a month ago when, sort of a mini war broke in the Middle East, people thought, oh, maybe this will be the catalyst, maybe the war will spread. But oil prices just haven't done anything. And these companies are still really sensitive to oil prices and natural gas prices. And natural gas prices have been particularly bad because after, the war in Ukraine started, at that point, people thought natural gas prices were going to stay high, very high for a very long time because they thought, as Europe pivots from Russian gas, it's going to create a lot more incremental demand. And gas prices have cratered too. And so it's really the commodity price for one. Two, I would say, oil companies, gas companies, they've been sort of doing what investors want them to do, and that is returning cash to shareholders. I mean, historically, this group, as a group, have done a terrible job. They've invested tons of money. They've never had a very good return. They basically sent a lot of money to the ground and never had a return, right? And so now actually they're sort of investing or returning capital to shareholders like they should. And so from that standpoint, the behavior is now, I guess, much more shareholder friendly. It's just that the commodity price hasn't, helped them out.
John, let's talk a little bit about financials, insurance companies, brokers, banks. Typically, these large financial institutions do pay a decent dividend. In a falling rate environment, they should start to do a little better. Do you guys own any banks in your, or brokers or insurance companies in your portfolio?
We do. I mean, especially in like the dividend portfolio and in sort of value portfolios in general, financials typically make up a big part of whatever index that would be. And so we do own a bunch of we do own various financial stocks. So yeah, so we like, I mean, so we, as an example, we're looking at Schwab. Schwab is a name that we think has a great competitive position. Their competitive position continues to get stronger. They like many other financial institutions have this sort of short-term issue where they can't really sell their bonds that are underwater because it would create a capital hole. And therefore they're earning less money than they normally would, and their funding costs have gone up. So for a period of time, they're being squeezed, but over time, those bonds roll off and that income will start to improve. And so you'll see decent earnings growth. And so a problem with a lot of the financials, right, is that interest rates went up too quickly. And so when they go up too quickly, you have a big capital loss in your balance sheet. You can't sell the bonds because it'll hurt your capital ratios. And so you're sort of stuck in this interim time period where, your earnings are lower, your costs are going up, but eventually that'll turn around.
So to that point, Sean, regional banks, even though they've come up from the bottom quite dramatically in the last month or so, still for the year have had a pretty rough year. Are the regional banks through the worst of this, or do they still have a lot to work out off their balance sheets?
We think that I think banks have more upside than downside at this point. So I guess we're leaning cautiously optimistic, but that's probably, I mean, I don't really cover the financial sector, but that's I think that's the internal view.
So Sean, getting away from the dividend payers, looking into 2024, again, I know you said we think we're going to have a soft landing. Is there anything that you worry about, whether it's, geopolitical, the upcoming election in a year? There's always things for us to worry about, right? There's never not something to worry about. But what do you see in 2024 that could be particularly troublesome if things just don't fall perfect for them?
Well, so I'll start off by saying that, as a firm, we generally don't make we don't make sector bets. And we're typically fully invested. And so despite all this talk about the economy, we're not making big economic bets in the portfolio. Mm-hmm. And so, I mean, it hurts us in the sense that, if things are worse than expected, the markets go down and that hurts, everybody. So one of the things that I'm worried about, well, one is, we're kind of threading a needle a little bit here. The bond markets are implying a bunch of Fed cuts next year. The Fed sort of hasn't really indicated they're going to cut a lot next year. And so, what's going to make the Fed cut next year? Is it really inflation falling, or is it if there's, some serious problems? And if there's some serious problems, well, you can bet that probably stocks went down in the meantime, right? And so that's one concern. Anytime we price in sort of the Goldilocks scenario, not too hot, not too cold, everything's sort of going to work out. I don't know. It's, forecasts are never quite right. So we'll see which way things go.
So Sean, on that point again, we obviously follow a lot of experts and people that we trust in the industry. And one of the things they keep bringing up is that earnings are likely to suffer next year. How do you guys feel about that?
Yeah, earnings, if you look outside of the Magnificent Seven and look at the rest of the S&P 500, through Q3, I think earnings were down 1 or 1.5%. And so, and those stocks, to be fair, are roughly flat, right? And so, the stocks really haven't done anything outside of the big tech names for the most part, and earnings really haven't done anything. And so as we move to next year, I think, you know, we have a few tailwinds. I think, you know, supply chain's getting better, inflation and cost inflation generally is getting better. And so there maybe should be a little bit of an uptick in margins. I think we think you're going to have a few percent earnings growth. I don't know if it's quite what expectations are, but we think you're going to have positive earnings. And again, the average multiple, if you look at the S&P, you know, equal weight as a proxy, you know, the average stock out there isn't that expensive. And so we think as you go from sort of a negative growth, which technically doesn't exist, or contraction of one or 2% to something positive, a reasonable multiple, you can have an okay year next year.
And again, I know you're not an economist, but are you guys okay with the general consensus that the fourth quarter of this year will come in somewhere between 1% and 2% GDP? And, you know, I think that's okay, right? I mean, that's slowing down without falling off a cliff.
Yeah, I think Q3 was 5, but then
Right.
if you look at the few quarters before that, they were all, you know, in the 2% range. You know, Q3 I think was sort of an anomaly and, you know, not really sustainable. So I don't see any reason why, you know, a 1 to 2% number isn't reasonable. I mean, we think the number is going to be positive because, you know, the reasons I sort of listed before, like ISM and all those other things, are still positive. And so, I mean, I don't know if the number is 1 or 2, but we think it's going to be positive. And so I think that's probably good enough.
And Sean, the consumer, you know, I think is stretched at this point. I mean, we're looking at how much debt they're carrying, but the employment numbers are pretty solid still and likely to continue through at least the early part of next year. So as long as the consumer stays relatively healthy, it's hard to envision where this economy falls off a cliff.
Yeah, and the consumer is actually overall healthier than they were pre-COVID. And so their balance sheets are better. And that's in part because during COVID, everybody got lots of stimulus checks and people stopped having fun and spending money for quite a while. All right. And so savings went up, stimulus checks came in. And then in the meantime, your house value, a lot of people own houses, their house value went up. Their stock portfolios have done okay. And so just looking at a consumer balance sheet, we look halfway decent and better than the numbers pre-COVID. So I think typically it's a good bet that Americans like to spend money, and if they have the money, they're going to spend it. And so I think we're in okay shape.
So we literally have about 2 minutes to go. So why don't you just do a quick commercial for Dana? We have, you know, you guys have been co-managing for us for many, many years. Why don't we just, for the last 2 minutes, Sean, tell our listeners who Dana are and, you know, what you guys do for us.
Oh, okay. Yeah, we've been around since 1980. We manage roughly $7 billion. We have large cap products. We have large cap value, large cap growth, large cap core product. We have a small cap product. We have a dividend product. A lot of those, and we have also, you know, a product called Unconstrained for those people high in the risk spectrum. But generally speaking, you know, our portfolios are relative value portfolios. We care about valuation. We think it limits risk. We tend to buy good, high quality companies at relative valuations, and we think sort of that combination over a business cycle results in outperformance, and generally the numbers have been pretty good, and it proves that out. So a lot of our business is institutional. We also do some individuals, but it's mainly institutional type business. And we've been, you know, it's one, I think, best places to work for every year that I've been there, and I've been there 7 years. And there, you know, one nice thing about it is that there is literally no turnover. I don't know of anybody that's left since I got there 7 years ago. And so it's a very stable place. It's a good group of people, a smart group of people, hardworking group of people. And I think we have some pretty good products.
Well, we appreciate your partnership and we thank you for your time this evening. And we wish you a happy holiday.
Sean, thank you for your insights, and we look forward to having you back. Thanks a lot.
Thanks a lot. Take care.
Take care. We'll be back next week with another report of the Lebenthal Report.